Alrighty. Hello, thank you all for coming and thank you for having us. We are Team 3 representing the University of Minnesota Twin Cities. We initiate a hold recommendation on Lifetime Fitness with a one-year target price of $28, representing a 5.8% upside from its current trading price of $26.47. Our investment recommendation is based upon 3 key drivers.
First, Lifetime is a good company, selling a luxury fitness experience that has led the market with stable revenues that can be easily priced in. Second, this luxury experience comes at a high cost, namely high operating costs that drive margins down below what we would expect from a premium brand like Lifetime. And third, each new Lifetime center must encapsulate the full Lifetime experience, meaning significant expenditures but not creating economies of scale.
Lifetime is a premium fitness brand that targets high-income consumers. While it has standard gym equipment, it differentiates itself by having specialized classes, premium instructors, and high-end amenities. By having multiple revenue streams, Lifetime is really able to go apart from just membership fees and really encourages their members to build a lifestyle at Lifetime. Turning to the broader industry, the U.S. health and fitness market is characterized as highly fragmented and low forecasted growth prospects. The industry has nearly 100,000 operators and is divided into 4 key segments: premium, boutique, middle, and budget. Lifetime sits primarily in the premium and middle category, where it competes with gyms such as Gold's Gym and Equinox. Here, retention is not driven by price, rather it's driven by premium experiences and great amenities. Additionally, forecasted growth has been to low single digits, which means any chance of scaling is met with high competition and low market growth. To better understand these market factors, we decided to conduct our own primary research through channel checks. Jackie will now share our key insights and research.
We called 50 Lifetimes across the U.S. and asked questions on pricing, utilization, and demand. We found that Lifetime members value their amenities, proximity, and their instructors. In fact, they really like those factors. But through all of that, we found that it seems pretty bullish of them to believe that, because over 25% of the locations we highlighted have had a wait list within the past 12 months, which seems pretty bullish. But the key idea is that the only way they can expand it is through scaling, and which is buying or having new, facilities and hiring new staff.
I will now dive into our financial analysis. Our first driver addresses the predictability of Lifetime's revenue, and it also addresses why we think that this is already included in their stock price. Lifetime has very high member engagement, but their revenue is predictable due to the fact that it's based off of the number of memberships they have, which is also very consistent with the number of locations they have. With every single location that Lifetime adds on, they are able to get a very predictable number of customers for each location. They get these at a very specific price point, and it scales at a very predictable rate. However, every single location also must sustain its own demand because consumers like going to their home gym. Along with this, the high usage that we've been talking about, that all the consumers have, is due to the fact that Lifetime provides an experience, but that experience is not scalable. Lifetime provides a variety of supplemental services. However, even though those are bringing in revenue streams, they're almost immediately met with even higher operating costs.
Just as revenues are predictable, so are the costs. Lifetime's operating expenses have been increasing per year along with their membership growth. So as revenue grows, the costs are right alongside of it. And this leads to the problem of having flatter margins that are more in comparison with their industry average peers. Lifetime is a premium brand that targets premium consumers, and yet their profitability is average due to the fact that those premium services come at a much higher cost. The biggest problem with Lifetime's profitability is the fact that its ROIC is below its weighted average cost of capital. Any pricing power that Lifetime has is almost immediately addressed with higher operating expenses.
As Sophia mentioned, the fitness industry is highly competitive. This leaves any company within it that's trying to scale to face some serious headwinds. Every single location that Lifetime opens must recreate the full Lifetime experience. However, they are capped by the high cost of providing that experience. You would think typically with a company, as they expand, they're able to reduce their costs, but with Lifetime, that's not the case. Because in order for Lifetime to grow, they have to increase their expense. This takes away the luxury that they would have of economies of scale. Another huge part of this driver is their recent transition to a sale-leaseback strategy. While sale-leasebacks do provide the liquidity necessary for expansion, they do not change the underlying economics. So while a company they could take on a loan to build a building, or they could take on a lease and pay rent. Either way, the high capital expense is still there. As part of our research, we screened for viable fitness centers according to Lifetime's target demographic, which is based off of population and income level. And based off of that, we came up with a lower number than management's estimate. One way that Lifetime generates revenue is through opening up new clubs. However, that long-term their long-term growth is essentially capped by that limited expansion.
Let's talk a bit about the valuation. We arrived at our target price of $28 using a combined valuation method with our DCF and relative, which had respective targets of $26 and $31. We weighted the DCF higher due to inherent limitations in constructing a true peer group for Lifetime, which Evelyn's going to discuss later. So diving more into our DCF, annual center openings and price increases drive a 10 to 12% revenue growth through 2030, but during this expansion period, CapEx is going to be kept at 15 to 20% of sales in order to fund this expansion. Overall, building this model helped us to understand that Lifetime cannot grow its revenues well without also expending significant capital and operating expenses. Now, let's look at the revenue build here. We can see revenue forecasts are driven by total active memberships and average revenue per membership. And based on these two drivers, as Kimmy mentioned, revenue is very predictable for this company. And because it is so predictable, we think that it is accurately reflected in today's market price. Now, in addition to these two revenue drivers, we added EBIT margin. EBIT margin as a additional driver for our scenario analysis. This is supposed to show a valuation range from $18 in our bear case to $37 in our bull case. But to better understand the probability distribution across this valuation range, we constructed a Monte Carlo simulation, and using these three stress points, ran the model for 10,000 iterations and found that 54% of scenarios support our hold recommendation. So I'll pass things off to Evelyn for the relative valuation.
The hardest challenge with the relative valuation is the lack of directly comparable publicly traded companies. Lifetime has two revenue streams that fundamentally differ in terms of margins and capital intensity. So to overcome this problem, we decided to take a sum of the parts approach by splitting Lifetime's EBITDA up into two segments, gym and leisure. From there, through our relative valuation, we got an implied share price of $31 per share.
Looking at their ESG now, they've made tremendous improvements to each area. But for this presentation, we're going to focus on key areas that are related to our hold recommendation. Starting with environment, they've made tremendous improvements to their sustainability initiatives. But although that's really positive for branding, we don't believe that it's going to impact our long-term returns. Looking at social, their instructors are the product. So you need to be able to pay them well and treat them well. Finally, looking at governance, the key to our governance is that they have a sale-leaseback strategy, and they basically have rent, and that rent, it goes onto the income statement and it limits the margins.
When analyzing the risks to our thesis, we found 4 separate ones, 2 of which would change our recommendation to a buy and 2 of them to a sell.
We want to reaffirm that Lifetime is a great company, but with high capital intensity and shares trading near intrinsic value, we reaffirm our stance on a hold at a $28 price target. Thank you for your time, and does anyone have any questions?
I'd like to apologize too for the slides that got blacked out. That was not our intention, and those do have some numbers and a lot of our hard work that we've done the past months on there. So I apologize for that.
But happy to answer any questions
Yeah,
about those
exactly.
things.
So what are the numbers on that parking slot?
Yes.
The one that's black?
Yeah.
This right
Let's
now.
go here. So our the operating assumptions for scenarios. So we have annual center openings, and for our bear case, that's going to be 10 to 12 per year. For our base case, we have it at 12 to 14, which is in line with management guidance. And then at the bullish end, we have 14 to 15. And this is going to drive membership, which drives revenue. We also have annual price increases for our bear case. That's going to be 3%, 4% for the base, and 5% for the bull. That's year over year. And then EBIT margins, which are going to, this long-term EBIT margin forecasting. So our second stage forecast is going to go down to this number, 9% for the base, 10% for the bull, and 15% for the bull. Or sorry, base is 10%, bull is 15.
That's good. Just testing you. My follow-up question, you keep talking about how cost is almost correlate to the revenues, but did you break down the cost? What's the fixed cost, i.e. maybe rents? What are the variable costs like labors? Is that really correlate together with the revenue? I mean, does the rent increase with more when you have more members? I'm just curious how you.
So with Lifetime's financial statements, they essentially bundle it all under operating expenses. And so that includes rent, wages, and then facility costs such as utilities. It doesn't specifically break out the numbers, but through their earning calls, they mentioned this as one of the toughest points of increases that they're experiencing. So that 12% growth in operating expenses was specifically due to new locations, which shows that those new locations are on average a higher cost to Lifetime.
Did you have a chance to evaluate governance and management compensation?
Yeah.
Yes.
Yes.
So in terms of governance, the breakdown, so one key factor is that the CEO is also the board chair, as well as he owns 7% of the company, and so that's a huge part of it. And in terms of the breakdown, so executive compensation is tied to two things. It's by lowering debt and increasing EBITDA, and they do that through the sale leaseback structure, and that's just basically reoccurring rent. And that's just going through that, it limits basically the margins that they're able to make. So they kind of just rearranged from having debt because basically they have these centers and then they sell them to lease them out. And they use the capital that they get from there to then purchase another facility.
Yeah, and I think a really key point of that is that Lifetime has been transitioning to these sale leasebacks, and it's within the company's favor for executive compensation because those sale leasebacks reduce their debt, but it increases their financial leverage with their long-term lease liabilities, which are not included in that long-term debt calculation for their compensation.
So gross margins and returns don't enter into their compensation structure?
No, it's specifically the size of EBITDA, not the margins. Correct.
On the Monte Carlo analysis, where you had the, a vast majority or a slight majority of the scenarios were the hold, what was the key variable that was kind of driving the different scenarios?
Yeah, so I would say each of these variables is really key to understanding, and this ties into the things that we use for the scenario analysis. So the two main revenue drivers are going to be center expansions because that increases your the amount of members you have, and then pricing changes are going to affect the amount of revenue you're able to get per member. And then COGS per sales, we're essentially using this as a proxy for the EBIT margin because it's the main driver on the other side of the costs here. So especially with the margin story that we think is true about Lifetime, they're going to hit these capped margins. We think COGS to sales is a really big driver here because while these two revenue drivers are very strong for the company, the COGS to sales ratio is really what's holding it back from the margin expansion that we think a lot of the street is pricing in.
Thank you.
Could you maybe just sketch in on the DCF, your assumptions of growth rate, margins, free cash flow, and terminal value?
Yes. So growth. Okay. Yeah. So our growth rate, I believe our terminal growth rate is about 2.5%, and then for margins, let's see. Can you go to the? Well, I suppose it's all blacked out.
I suppose it's all blacked out.
Yeah. So yeah, our growth rate long term is 2.5%, and then I don't have the specific numbers with me right now, just because of like the blackout. So we can actually look at that after and chat about that.
Right.
Did you ever think about considering how this would compare to a company like Delta Airlines? Just because it's premium product in a very commodity, capital-intensive business. Just differentiate. You had a very difficult time because you didn't have a lot of public companies.
Yeah, it was a very difficult time trying to create that peer group, and I actually do think that Delta might have been a really great one to put in.
The thing I will say about Delta and airline companies as a whole is they're much more volatile than the gym industry. Sure, you might, when the economy's down, you'll be like, oh, I should cancel my gym membership. But people are still gonna fly consistently and go to the gym consistently, but one is just harder to value because it's more volatile in the past.
I have a couple questions for y'all. But first I want to apologize for coming in late. That's never acceptable, but I was more lost in like a investor in a experience. So sorry about that. So a couple of questions. First of all, how did you deal with the cyclicality of the gym industry when you were thinking about the valuation?
So for the valuation for Lifetime, when thinking about the cyclicality, we didn't necessarily look at it from the same perspective as you would for Planet Fitness, because a lot of those members that use that gym are extremely price sensitive, whereas the members at Lifetime have a higher income and they're not as sensitive to price increases. And I mean, we can even show too, but they've been able to continue to grow their per membership cost and how much they charge their members while still growing their memberships too. So I think when it comes to the cyclicality of Lifetime, it's a little bit different from your average, lower middle market gym.
All right, what about quarterly seasonality?
Yeah, as for quarterly seasonality, specifically, we tried to just average things out across the year. So we're normalizing the two main revenue drivers, which again are center openings, revenue per membership. So I don't think we've taken into account maybe the ups and downs of that, but we're on the middle of that and trying to understand it, how it's going to look year over year.
I'm just curious, what did that data look like over the course of the year?
Yeah, so we tend to see a spike in January.
We've seen that, yeah.
Right, and it goes down, but we tend to find that it averages out to a pretty steady year-over-year increase. It's pretty cyclical around a steady long-term growth trend is what we found.
Yeah, and I would also say too that Lifetime has a pretty stickiness with their memberships, so they don't have as high of turnover, and so they keep a pretty consistent membership base throughout the year. And also through our channel checks, finding out that 27% of the locations that we called within the past year have a wait list. It kind of shows that those locations are already servicing as many members as they can, and they're not growing it as much. So maybe not as affected by the cyclicality part.
Okay. You mentioned that you had recommendations to go either more positive or more negative on the stock. If you can just give us the elevator pitch on each of those.
Yeah, absolutely. So yeah, two of our risks we assessed would change our recommendation to a sell and two of them to a buy. The sell ones that we identified was a decrease in consumer spending and then also a change in consumer behavior. The change in consumer behavior could be influenced by things like fitness trends or the use of GLP-1 drugs such as Ozempic and Wegovy. And then the risk that would change it to a buy would be an increase in the supplementary revenue or a decrease in the cost of their expansion strategy. Yes.
I have one more, but I'll share. Does anyone else want the time? Okay, last question for you. When you think about portfolio management, what are the circumstances under which this fits in well with a broader slate of portfolio names?
I would say the diversification benefit of it. I've never run my own portfolio, but I imagine there's a diversification aspect of it. And I think with a gym company, it typically moves, similarly to the market, and so it could give a diversification benefit from that.
Time's there.
Last shots.
I guess just to add, Lifetime has a diverse set of revenue, which helps them be a great addition to the portfolio. Thank you.
Thank you.